Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BASL, and certification from NASM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.
Hello everyone, welcome back to the QID podcast. As always, we've been irregularly regular, leading to a lot of gaps in between. Hopefully it will all settle down and we'll have a constant connect with you all over the period of next 3 to 4 months. Today we have Parvadha Vardhini again. I'm going to call her Vardhini. She needs no introduction, and she's been a journalist for a very long time. She used to head a couple of products and stuff like that in business line, and she is a qualified chartered accountant and market expert to begin with, right? I mean, she understands the Indian market. She understands trade. She understands investing as a subject, and she does a lot of having hung up her boots from business line. She's doing a lot of programs to promote financial literacy, to help people understand how investing can help their own financial future. And we are very, very honored to have Vardhini here with us today. And we just thought that, today we'll get into a little topical subject. Not exactly topical because this has been happening over the last, I think, 2-3 weeks or so. But it is still something which is capturing the imagination of most people, especially people who are in the markets in some form or the other, either as investors or as traders, or as people who are just interested in the markets, and also people who are interested in geopolitics. We'll get into this subject with Vardhini today and understand what is this animal called tariff and why this tariff between US and India is now a big scene. And we will try and keep it as simple as possible so that you and I can understand this a little bit better than what we had as understanding before. So that is basically the thought process. Welcome, Vardhini. Good to see you again. And today, hopefully, we should not have any tech glitches and stuff like that. So
yeah,
let's walk.
Yeah, thank you, Kishore. It's a pleasure joining you as always. And you said irregularly regular, but then there's nothing like doing a podcast or writing, for that matter, when events happen. If events happen regularly, you could. Otherwise, no harm in being irregularly regular is what I feel, because you are timing it. So
wonderful. Thank you for being kind with us. So anyway, I mean, we'll just jump straight in. I just wanted to first understand this animal called tariff. Yeah, I mean, of course, I understand in my own way. But I just wanted to make sure that people who are listening in you do know that I send these podcasts to all our investors.
Right.
It will probably help in understanding this tariff from a very simplistic perspective and also from an investor's perspective.
Right.
So over to you, Vardhini.
Yeah. So I'm sure any investor would have, from April till date, would have surely read up something and got a basic idea. But definitely, so generally you have taxes, whether it is, your personal tax or domestic manufacturing or services, which is your GST. The council meeting is going on. So, so like that, you also have taxes on exports and imports. So simply said, the rate or whatever at which you're taxed. So essentially, you may call it a tariff in other words. For example, when you go to a hotel, you'll ask them, what is the room tariff? So, these words are used very interchangeably. So essentially on export and imports, you have certain percentages of taxation. So now what happens here is, there is a WTO, which is a World Trade Organization. And you have a lot of countries which are members of WTO. And then, they have agreed rates on export and imports. So countries which are members of WTO will have a certain set of rates, which they call as most favored nation or MFN rates. Now, there are also outside of this, treaties between certain countries. So then these countries discuss favorably on what taxes they can charge for exports and imports between or among these countries. So you may have among countries in a region or between two countries. For example, recently we signed a very good or a successful treaty with the UK. And so that way. So tariffs are essentially these rates or the rates of taxes which you charge on imports and exports on certain goods, depending on how you sign the deal with a particular country or based on WTO broad framework. Yeah.
So, which basically means, in my understanding, that India, if it's importing something from, let's say, UK or US, will be having a certain tax on the price of the product. Let's say we are importing Harley Davidson bikes, which means that on Harley Davidson bikes, which may cost, let's say, 100 rupees, there will be an additional tariff charged by the government, which will be paid by the consumer here, which means that an Indian buying a Harley Davidson in India, which is imported from US, will not be paying 100 rupees, but he or she could be paying 110 or 115 or 120. I don't know how much it is, right? Similarly, anything that goes from India to US is also having what is called as a tariff. So on the price of the product, there is a additional tax by the government.
Yes.
Very simply, this is what tariff is. Fantastic, right? So with this as a background, we are now having a lot of noise over the last few weeks about this US tariff, right? Additional 25%, 25% tariff plus additional. This is like this plus this plus this plus this, right? So it's becoming one major discussion point, and you open any social media today, or you open any channel today, or you open any newspaper today, there is definitely something about this US-India ties, US-India tariff. It is becoming a little, extra noisy. So what is this particular issue that we are trying to deal with? You can, again, simplify it for our...
So as you rightly put it, ultimately, there are two things here. One thing is why this additional taxes are being imposed by the US across nations. It's not only for India. So first it started off with China, and then it moved on to India. So as you rightly said, what happens is whatever is being imported into America from India is facing additional tariffs. There are two parts to this story. One story is that the US administration is looking at manufacturing things there or producing things in America rather than importing it from other countries. So they want to make, for example, even today, if you go to the US, or when I visited the US last year, or when guests come from there, they bring you a lot of things. And if you see, the labels, I'm surprised that I get clothes which are made in India. So made in Cambodia, made in Vietnam, made in Thailand. You won't get, you see, seriously, you won't get anything as made in USA in America. Made in China is also a very popular label. So that is essentially what it is all about. So the latest administration is looking at making things in America as much as we are looking at make in India or going Swadeshi. So now, they are trying to discourage these imports. Which is why you get additional taxes being imposed on them. This is one side of the story. The second side of the story is what happens in the immediate. So over a long term, the US is looking to transition from being an importer of so many other products to probably a manufacturer, or at least making a value addition in the US. Now, the other side of the story is what happens in the interim. See, this is a long drawn out process. Now, what happens in the interim is that the US consumer, because of these additional tariffs, so like how you explained with your Harley Davidson example, because of these additional tax rates, previously if they were paying 100 or 105, today because of this additional initial 25 and an additional 25, they may be paying 150 instead of even 100 or 125. It may be 150 on certain products, like textiles is a good example. So what will happen to the US consumer? Now the price is rising for the US consumer. So the US consumer is going to think twice before purchasing. So when they start thinking twice before purchasing, all the textile manufacturing orders, which is going from India there, that will start facing a slowdown. So for us as an exporting nation, the problem comes because you have manufacturing capacities here, you have labor here, and you are running an establishment with a lot of fixed costs and a lot of even recurring monthly costs, whether you manufacture or not, like salaries, for example, for the labor. Then what do you do here? You get into a problem and there is a slowdown. So these are the 2-3 sides to the whole story.
So, so as a common man, sitting in India, any city in India, or any tier 1, tier 2, tier 3 town or village in India, what is the impact? If you can just try and share your views on it. Apart from A, possibly losing jobs, B, possibly facing a slowing down on the economy, is there anything that a common man needs to be wary of?
So essentially, whatever happens to the economy happens to us also, personally, in a way. Number one, as you rightly said, there are certain sectors which are faced with this additional, initially 25% and an additional 25% as it's been going on. So there is a great risk of job loss in these sectors, which is ultimately going to pinch your pockets. So that is definitely one thing. The other thing is, overall, when there is a slowdown in all this, so what kind of economic growth are you going to face? An economic slowdown or something? So when these things happen, even if you're in a good job, even if you're in an unrelated job, if you're in an economy which is slowing down, what happens to your salary hikes, or your, if you have invested and if the markets are reacting negatively or are wary of these, this whole geopolitical uncertainties and all that, what happens to your investments? These are the primary factors. Number one, if you don't get your hikes properly, if you lose your job, it's entirely a different thing. If you don't get your hikes properly, your disposable income or your investable surplus, these become, a question mark. So you'll probably be stagnating rather than accelerating or stepping up your investments. And number two, even if you are able to invest at the current pace or at a higher, or put in more, the problem comes when markets stagnate instead of your salary stagnating. Even if your salary grows, markets may stagnate. So, so as we have seen, markets touched peak last September, and it's almost 1 year. September 26, it will be 1 year. So we've gone nowhere. We've done rounds. So every time and there is an FPI pull out, there is some DII push. So this is what happens. So Indian institutions keep buying when foreign institutions sell out. So somewhere, markets has moved up and down, but somewhere we are slightly down, but not double down in double digits. So to that extent, market stagnation might work on your, in the short term, I'm not talking about long term, might work on your investments and all that in the short term when these uncertainties go on. So these are the 2-3 ways, I think, which is these developments affect the common man, and which is why probably you should take note of it.
Wonderful. So you touched that nerve, right? We spoke about investments, right? So, when it comes to investments, I mean, at least I am of the view that you should never look at it from a 1 year perspective. Especially if you are putting your money into equity, definitely not 1 year perspective. I think I have mentioned this before. There was an Australian fund manager who said, in Australia, the long term means 10 years, short term means at least 3 years. But in India, short term is afternoon. Long term capital gains tax. I mean, even the government seem to be agreeing that long term means 1 year above. So I am of the view that you should always look at it from a 5 year or a 10 year perspective, right? So with investors in mind, not traders, right? Investors in mind. I firmly believe that all these things that is happening. In fact, the last 1 year we've been accumulating in our own for our own clients. We've been accumulating a lot of equity over the last one. I've pushed up the equity exposure significantly for many of my clients, because I see it from a 2029 or a 2030 perspective. Right? So, what is your view on that?
Sure, definitely. So, events keep happening and markets keep reacting. It is all about your, how close you are or how far away you are from your goals. Now, if you are somebody in your 30s or even early 40s, late 40s, doing retirement planning for 60 or 65, these things are just a blip. And this is the volatility. See, you're looking for something higher than risk-free returns, something which will give you a risk premium as well as cover inflation. So whenever we look at whatever, see, if you see an FD or a government security is giving you a 6% and your inflation is at 2%, so essentially 8% is a return which you are expecting without taking risk. So now you're taking risk for investing in equities, and you expect say a long-term return of 12%. Now, equity is something which is very capable of giving you a long-term return. I'm talking in terms of compounded annual growth rates, a long-term return of 12%. So when you are investing in equity for that purpose and your goal is so many years away, these are temporary blips. I'm not saying you should not read about it. You should read about it. But whether you should worry about it in the immediate term, whether you should look at your portfolio, the green and the red arrows every day in your screens, seeing the NAVs move up and down, and say your total sum moving up or down by your total sum that you have invested, market value of the sum you have invested so far, moving up or down by a few lakhs. That should not matter. You should not be bothered about that at this point in time. If your goals, we even say, equity, if your goals are at least 7 to 10 years away, at least, you don't have to really worry about it. So any long-term investor, it is good to keep tabs on these things. But whether to take action, what action I would say is, the action that you have to take is, don't take any knee-jerk reactions, like stopping SIPs temporarily, saying let me wait and watch. These are the things that you should avoid at this point in time.
Wonderful.
If you see SIP data itself, since SIP is a more common way of investing for the salaried class, SIP data itself, if you see from AMFI puts it out every month, from last September until now, where markets have not gone anywhere, and where corporate earnings, there has been a slowdown, and now this tariff uncertainty and all that. Per month, last September, I think we were collecting 24,000 crores or so. July data shows we are collecting 28,000. So per month, and there's been a steady rise, 24, 25, 26, 27, and this is a time when market has been uncertain. So it also shows that investors now are a little more informed that whatever happens, if you have long-term goals, don't do anything to your SIPs. And if market falls, it's a good time also to probably step up, if you have the investable surplus.
Brilliant. So which is precisely what I was about to ask you. I mean, 2 points you've already touched, which is, investors are becoming slightly more informed, thanks to people like you who have been writing about it for God knows how many years now, right? And also to all those people who are taking financial education as a passion and have been doing it, comes to each and every one of them. People have become a lot more informed, and as you said, the SIP data, which kind of bolsters the domestic institutional investors a lot more, right? I mean, even our finance minister in the parliament said that, the common retail man saved the Indian markets and stuff like that. So it's a reflection of what has been happening over a long period of time with respect to financial education. And thank you very much for that. The second point that I wanted to, kind of, if you can share your views on that, is, does this actually provide an opportunity? Because I personally, what I have been doing is, like, see, I see Nifty 50 from its previous peak, it is down by almost 6%, right? On a 1 year basis, it's probably down by about 2-3% or so. But from previous peak, like September 27 last year to now, it is down by almost 6.8% as I saw it yesterday, right? And if you see Nifty Next 50, which is a 51 to 100 company, that is down by almost 16%, right? Which I see as an opportunity for you to get a little bit more exposure and then chill, right? I mean, considering you anyway spoke about 5-7 year kind of a window at least, right? Which is what I've also been speaking about. If your window is at least 5 to 7 years, I see that as an opportunity to invest more rather than cut down on this. So your views on that?
Yeah.
A follow-up on that is, I see a lot of people getting into, it's a slightly touchy topic, but I'll anyway say it, getting into real estate purchase right now, right? And I'm not saying you should not buy real estate. Everyone must have a house. I mean, they all deserve it, right? But what people tend to forget is, when they buy real estate, the immediate impact is on their building their own retirement corpus. So when you buy real estate, unknowingly or knowingly, you end up stopping your SIPs, and that also is something that I'm seeing happening. So first is 7-year window, and the second is, do you see an opportunity because you have a 7-year window? And the second is, when you're buying real estate at this point of time, it forces you to stop your SIPs or probably even withdraw when the markets are flat, volatile, or down. What is your view on that?
Yeah. So on your question of looking at how much the market has fallen since the previous peak, so definitely whenever we see, when I'm saying as an analyst, as an observer, and as also a former, I have curated an edition on investments and personal finance at Business Line. So as a former content curator, so whenever you see these kind of dips, we use our databases and we see how, whether the dip is across the board. At the index level, you can see dips. It is also because of weightages. For example, the Nifty may be high on banking and financial services and so on and so forth. So the index dip is also because of weightages and other factors. So what we try and do is see at the broader market level, do a graph or a distribution to see how many stocks inside the index have fallen in the range of up to 10% or 20 to 30% or more than 30% and all that. So, so that is a factor which will tell you whether across the markets, there is a reaction, number one. So when you find situations like that, the other thing you also do is to do a valuation check. So, valuation depends on both earnings as well as price. So, even as price falls, if your earnings outlook is good, then it is, it's an ideal, there is a price fall in the earnings outlook, but these kind of ideal situations are very rare. So sometimes the price fall also happens because the outlook is cloudy. So these are 2-3 factors along with what you said. Yes, markets, indices broader, and since you also advocate passives and index-based investing, index fall is a good factor to note. At the same time, I would urge investors to also look at, how broadly the market, the broader spread of the fall, as well as the valuations at which you're investing. So, for example, today, if you see Nifty at the peak last September, Nifty's trailing valuation, which is the common thing which we see, was at some 24 times or something. So today, if you see Nifty's trailing valuation is at trailing 12-month or 4-quarter valuation is at some 21 times. Now this 21 time is, including COVID years where there was like, a spike in the PE because of fall in earnings. So at that time, 21 is close to a 10-15-year average. So including the COVID period. So we wouldn't say market is very expensive today. At the same time, earnings outlook in the immediate term remains cloudy. So whatever be the institution, if you see Bloomberg, or if you follow MSCI, or if you even follow the good brokerages out there in the country, so most of them are giving a very, a very dull picture for 2025 or even financial year 26 earnings. So, this is an uncertain time, definitely. Market has fallen, but prospects also in the near term remain uncertain. So taking these three factors, valuation, outlook, as well as your market fall into consideration, I think, it is, when you start investing, these are the times which may give opportunities, definitely, because only when there is uncertainty, there is always opportunity in the market. So at this point in time, you take these three factors into consideration, and then you can take an investment call. Definitely not a bad time to invest at all. Yeah.
Fantastic. I mean, great. That kind of almost, validates what I was also having in mind. Although, I'm not as, I tried to get into a simplistic mode of this thing, but you also seem to have a technical view about it. So great. And now on the real estate point,
yes. So see, real estate, in India, it's a sentiment from what I have seen. See, I feel some land versus buying an apartment or a whatever. No, these are 2-3 things. Now, land in a place where rates are not bloated, where you can expect appreciation. You want a certain set of real estate exposure. I mean, a certain percentage of real estate exposure in your portfolio is fine. But if you're looking at apartment outside of your own living and things like that, all of us know that rental deals are not great, and it can't be. You are essentially locking up your capital if you don't have enough capital. We are not talking about HNIs, who still have a lot of disposable investable surplus to put in equities, and then they also buy real estate for diversification. That is a different category. Now, if you're looking at a category where you already have a house, you already, have done your base, you have your basics in place, and then you're trying to do some more real estate investment at the cost of equity investment. If you look at that category, then probably, equity investing will give you more liquidity. And there is also the fact that, you don't know about, you can look at NHB, National Housing Bank data for how much appreciation has been there in different cities and all that. A lot of friends will tell you about land price appreciation, all that. But markets, you have a lot of data. You have, and that early double-digit returns over the long term is definite possibility in equities. So at the cost, see, you always have an asset allocation, as we all suggest. So you have debt, you have equity, you have gold, you have land, real estate. So that is also an asset class which you can invest in. There is no harm. But at the cost of equity, are you locking your money into assets which cannot be sold easily, assets where appreciation is it documented, is there a question mark? Then yes, if you're being underweight in equities to go into to other segments where there are question marks, then yes, you'll have to think more than twice about it.
Wonderful. So I mean, it kind of validates again, a lot of points that that I have been talking to my clients and stuff like that, in terms of how you'll need to have an asset allocation and how equity is important when it comes to building your own retirement portfolio. And you also spoke about HNIs getting into diversification, because this is something which I've been speaking about pretty regularly as well. Right? A common man having one apartment where he or she is living, I will sell equity to buy a land, either because of parental pressure or family pressure or things like that. And not even, or not even willing to let go of an existing land which they've bought. Like, a recent case is one gentleman who bought a piece of land up north for 16 lakhs. Today it is worth about, if he sells it, it's in a big city in north, in UP. If he sells it today, it will go for at least 1.75 to 1.8 crores. Right? Family doesn't want him to let go of it. Right? It's a problem, right? Will it grow at the same rate that it has been growing from 16 to 1.8? Fantastic, great growth.
Yeah.
But you should also know where to say, okay, this is where it will stop for me, right? And then probably have a very pure logical approach towards money as a subject, as against emotional. So that is something which
That's true. Nobody holds on to equities as an emotion as much as they hold on to land or even
gold.
apartment or gold. Yeah, that's what I was going to say.
Never sell.
Yeah. That's very true. Financial assets, people don't seem to have attachment, which is why they end up saying, I see also the fact is liquidity, isn't it? That is also a factor. So yeah.
No, I in fact I go one step on the opposite side. I mean, I don't get attached to anything, not to gold, not to real estate, not to equity. But the problem is we are selectively attached. Real
Maybe
estate.
it's a traditional mindset. Household savings have always see gold as a prestige issue, and land also as an essential. I mean, we always say no roti kapada. So land, you need land is. Anybody for that matter looking to settle down in life needs a property. Needs so that becomes a basic need when it comes to investing.
Absolutely. I mean, I don't question that at all. I mean, this is why when I asked you the question also, I clearly said that one house is definitely required for all of us deserve it.
Yeah.
Right? But to treat real estate as an investment, one needs to be a little bit more evolved.
Right.
In the sense that one needs to be a little less attached to real estate, less attached to any form of investment, because you'll need to the more it flows, the more it grows.
Right.
Something which people tend to forget. But anyway, I mean, so absolutely wonderful. But closing thoughts for common people, right? If you would like to share anything from your side as to what they should or should not do in the next, let's say, 1 year.
Oh, see, the thing is, don't, as I said earlier, don't really look at day-to-day news developments and make up your mind on anything. See, that is why it is always said best to have an advisor, or best to have somebody who can handhold you if you don't have the confidence that you will continue with the regimen. See, it's also like, your dieting or exercise or whatever. Even for diabetes, you have to continue to not have sugar. You can't sit for 1 week, I won't have sugar, and later on binge on sugar. So this is also like that. It has to be a continuous process. So please follow the news and be aware and look at an asset allocation. If the market is overheating or anything, if your equity allocation for whatever you've discussed with your advisor has gone overboard, then you can book profits and get out and things like that. But if you're, that is a different story. But if you look at developments and start reacting, the problem is the markets discount developments much before you. So, yours will be an after reaction actually. And the market may actually, rebound, after you have reacted. So you would have you can never time the market. So which is why we say, don't attempt to time the market. You can never find, you can never say this is the top. How many people exactly sold on September 26th last year? I mean, that's not needed actually. How many people exactly bought when Nifty touched 22,000 in early April? These things are very tough to time. In hindsight, it may have been a coincidence. But so your regular timely investments, if you keep going, keep tabs of the news. When you have an over allocation or under allocation, make sure that you move back to the ideal allocation, which you have discussed with your investment advisor. So beyond that, you don't have to do much at all if you're a long-term investor. And anyway, equity market, we are not, We are not here to advise. I am not a technical analyst, or I am not an F&O expert to advise how to position yourself for this develop. Today, GST Council meeting is happening, how to position yourself. Tomorrow, relief package for MSMEs will come, how to position yourself. I mean, I am not in that business, and I'm sure you're also not in that business, essentially. So we are talking only for long-term investors. So very little has to be done. So most people, whenever you speak to, will always say, the best thing is to not to react to any of these things. Just keep tabs and then keep moving on. It's always good to be knowledgeable. But, depending on how your portfolio has performed and all that, you can take calls rather than taking calls as a reaction. Yeah.
Brilliant. So it's absolutely wonderful to, speak to you, get validated, and, have a person who's able to explain a lot of deeply technical things in a very, very simple way. I really enjoy these conversations. Thank you very, very much, Vardhini, and viewers, listeners, whoever comes across this podcast. Simple message, right? Please read the news, but learn to ignore the noise. All news does not warrant your reaction. All news does not warrant action. Some news may be of value to you. Read the news, be knowledgeable, absolutely fine, but don't lose your discipline. So do not, if you are a retail investor trying to build your retirement corpus, do not stop your SIPs. If you are a retail investor who's going to retire in 2039, this is just a blip. Vardhini said this more than once in this podcast, that it's just a blip. So you may probably in 2039, you will not remember what happened on 2nd September 2025. It is not possible for most of us, right? So please do not, act and react for everything that you come across. These things happen. These things must happen, will happen, may continue to happen, but you'll need to keep your focus in place. So on that note, thank you very, very much, Vardhini. I really appreciate your time once again. I hope to see you soon.
Thank you. It was a pleasure joining you. Yes, we will meet again. Yeah.
So that was today's episode. Thank you very, very much for listening in. We hope to see you soon. This podcast is intended to provide helpful and informative material on the subject matter covered. It is given with the understanding that the podcasters of this material are not engaged in rendering professional services through this program. If the listener requires personal assistance or advice, a competent professional should be consulted. The podcasters specifically disclaim any responsibility for any loss, liability, or risk, personal or otherwise, which is incurred as a consequence, directly or indirectly, of the use of any of the contents. The contents are general information that is intended to, but not guaranteed to be correct or updated. The information is not presented as a source of investment, insurance, or legal advice. You should not rely on the statements or representations made in this podcast or by any externally referenced sources. If you need investment or tax advice upon which you intend to rely in the course of your financial and business affairs, please consult a competent, independent, registered financial advisor. The content should not be taken as financial advice or as an offer to buy or sell securities, insurance, funds, or any financial products. It should not be taken as an endorsement, recommendation of any particular company or individual, and no responsibility can be taken for inaccuracies, omissions, or errors. The information presented is not to be considered as investment advice. The podcasters do not assume any responsibility for actions or non-actions taken by people who have listened to this program, and no one shall be entitled to claim for detrimental reliance or non-reliance upon any information provided or expressed herein. Your use of any information provided herein does not constitute any type of contractual relationship between yourselves and providers of such information. The podcasters hereby disclaim all responsibility and liability for all use of any information in this program.